Welcome to the Commercial Real Estate Show, your source for insightful analysis and enlightening discussions. Hello, I'm Michael Bull. Thanks for joining us on one of the 44 radio stations around the country on iTunes, YouTube, or the show website, commercialrealestateshow.com. Well, today we have an awesome show for you. We're going to have the Fed's view on commercial real estate. Part of the reason it's going to be awesome is our awesome guest. It's Brian Bailey. He is the senior financial policy analyst and covers real estate for the Fed. He's here in Studio One with us. Brian, thanks for joining us.
Thank you, Michael. It's great to be back.
Well, we appreciate it. And, we've had you on the show before. It's very informative, and we really appreciate you being here and looking forward to it. And we're going to get into some heavy commercial real estate, some interesting commercial real estate. But before we do that, just briefly, what is the Fed's mission?
Absolutely, and the Fed's mission has several tiers to it, but one, as the audience is aware of, is kind of the dual mandate. So we have price stability, we also have full employment, and certainly the key tool in that chest of tools is interest rates and setting those rates. Mm-hmm. But obviously there are other things that we have, for instance, bank regulation and regulation of systemically important financial institutions. So spending a lot of time these days ensuring the safety and soundness of the financial system. And then one other thing that we have is we run the intrabank payment system. Mm-hmm. So have a lot going on.
Yeah, you certainly do. And you cover commercial real estate. And so tell us what you do for the Fed.
I'm the subject matter expert in commercial real estate for the Federal Reserve Bank of Atlanta.
Mm-hmm.
However, there are not a lot of folks like me with my skill set in the system.
Mm-hmm.
And so I'm allowed to engage in commercial real estate issues across the nation to support our examiners as we are looking at commercial real estate loans in the banks to ensure the safety and soundness of the financial system, to ensure that the banks have complied with the regulation. So it allows me a unique insight into the workings of commercial real estate as we work through the banks and look at that. The other thing that I've been allowed to do is to spend a lot of time out speaking about my thoughts on commercial real estate and so forth like that.
Okay, well, good. So if Obama wants to invest in commercial real estate, he can just call you, right?
That's very kind. I don't think I'll be getting that call, but he's very kind. Yeah.
And one of the things that might surprise people about the Fed, right, is the money flow, the cost, right? Who pays for it?
Well, yes. I mean, so we're allowed by an act of Congress to charge the banks for the services that we render, and we turn a profit from that and we turn it over to the U.S. Treasury. So we are a self-supporting unit.
Thank you very much for that. That's what we need from the government, right?
I think we only turned over roughly $90 billion over the last year or so, give or take.
Very good.
Yeah,
thank you.
A little profit.
Thank you. I need that.
Yeah.
Well, talk to us about the scope of commercial real estate in the economy. I think some people don't really realize how much employment and construction and the huge impact on the economy that commercial real estate has, right?
It's huge. So in 2014, just over $1 trillion was spent on real estate related projects, whether that would be residential home construction, commercial real estate construction, renovation. So a very large number, accounts for roughly 6% of gross domestic product. Compare that to 2006, we spent, the nation on average, or overall spent about $1.2 trillion, and at that point it was about 9% of GDP. So real estate is a significant component of the nation's overall economy. The Fed is very interested because banks have between $1.5 and $1.6 trillion on their balance sheets right now of commercial real estate loans. So certainly a very, very, vast number. Great news is that we're seeing a significant improvement in lending. So you take the kind of the stabilized properties, so owner-occupied, other-occupied property, which would be kind of lease space, and then multifamily. And the balances at banks for those three segments have hit all-time highs over the last 8 years. So certainly we are seeing banks returning to the lending space, going, looking at the other loans, the construction development loans, which are the more risky loans, and certainly, an area that the banks were badly burned during the downturn. However, in the last year, we're beginning to see noticeable growth in those areas, and so I think it is a sign that the nation's economy is beginning to hit on one of the last cylinders that wasn't hitting, and that is real estate construction.
Okay. And does the Fed have a recommendation to the banks about how much commercial real estate loans they should have in their books?
Yes. I mean, we have several. They're called SR letters, supervision regulation letters, which give guidance. It's basically 100% of capital, not greater than 100% of capital on the more risky loans, and then it's not greater than 300% capital on the commercial real estate loans. But certainly there are other pieces. I mean, we have guidance on stress testing. We have guidance on appraisals. So there's lots of regulation to look at.
Right. So there's a comfort level now with the level of commercial real estate loans that the banks have.
A comfort that they are getting back to business and getting back to lending, and they're spending more time doing their homework, doing due diligence, which I think is certainly a wonderful thing. It's certainly when the time is right, when the economic situation is right, certainly like to see those loans made, but certainly want to do it, see it done the right way.
Yeah, well, it's a good point, and it's interesting to see how much banks have learned about commercial real estate in this past downturn. Right? I mean, they went from but to be nice to them, not knowing a lot about commercial real estate, to having to learn a lot about real estate, and it should help them with the underwriting and decisions moving forward, shouldn't it?
I'm excited about the progress that banks have made in the commercial real estate realm. I mean, having seen it, for the last 4 or 5 years that I've been at the Fed, it really has changed throughout, a number of the kind of the gradients of the banks. You've seen the large banks improve their skill sets in commercial real estate. You've seen the regionals, even down to the community banks, and so I'm still a ways to go. There's still areas of improvement, but I think that there has been a lot of progress made in the area of commercial real estate knowledge for financial institutions.
Yeah, and it certainly helps the overall economy too, to see banks be able to provide financing for the tenants and for the investors and for the companies that are expanding and need real estate. And one of the things that some borrowers are suggesting is the banks are still a little too stringent on their underwriting. We've had some people in our audience comment that maybe underwriting is getting a little loose. What do you guys think?
Well, I think certainly you have to look at the context. So some of those comments are made around the CMBS market, which has certainly been, it was an area in 2007 and 2008, 2009, where we saw, significant losses. And so certainly is an area that I kind of continue to watch. Certainly, I think it's kind of finding a balance right now. We've come out of a deep economic trough. We're seeing robust growth, and so certainly, I think banks have got to kind of figure out what's the right underwriting criteria for the time. But certainly you have to keep in mind, and we're asking them to keep in mind with some of the regulations based around stress testing, certainly we have to be mindful of what we just came through. And, we have to do lending, the right way.
Yeah, and part of the underwriting I think that's really tough is on these construction loans, right? And you mentioned that banks and other lenders are looking more at construction loans. Where are construction levels? It seems like the low-level construction has really helped the fundamentals of the industry, hasn't it?
And I think it will help the industry for the next couple of years. Probably my one exception would be multifamily. But I think that nationwide, on average for office space, we were delivering about 1.4% of the existing inventory per year over the last 15 years. In 2014, which is our latest snapshot of it, the number was half of that. So we're delivering about 0.7% of the existing inventory in 2014. So certainly, a significant difference from where we were over the last 15 years. It's the same dynamic for industrial, though the difference is about 20% below long-term averages. Retail, it's much more severe. It's about 68% or so below the long-term average. So certainly, we have a fair ways to go, I think, over the next few years.
Yeah, good point. Well said. Well, stay tuned. We'll have more from Brian Bailey with the Fed's view on commercial real estate. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back to the Commercial Real Estate Show. Our topic today, the Fed's view on commercial real estate. We have Brian Bailey here with us in Studio One. He's the Fed's analyst for commercial real estate. And Brian, we were talking about construction before the break, and I think a lot of the listeners are kind of curious, and people have varying opinions on where we are now in the commercial real estate market. We've had a nice run up, and it seems like things are very positive. Where are we?
And it's a question a lot of people are asking. So thank you for the opportunity to address the topic. And first of all, I've got to qualify my remarks with, real estate is a very broad subject, right. And so very sector specific. And so I'll talk kind of nationally. And certainly it's positive news that we've created 250,000 jobs on average a month over the last year. The last month we created roughly 280,000 jobs. So certainly there is a need for office and industrial and retail space. And so we see that translating into the decline in vacancy rates across the nation. Again, some markets are stronger than others. Certainly some product types, barely felt the downturn. For instance, luxury retailers, never felt it. But certainly, we're seeing that improvement across the board right now, pretty much, as far as an improvement in vacancy rates. Correspondingly, you're seeing rental rates, begin to see some upward pressure, more so in industrial than office and retail, but seeing it in office as well. I think retail is kind of the laggard right now generally, and I think my view is we have a lot of retail space, and there probably is some surplus space. But certainly, we're seeing the implications of changing uses of real estate. For instance, we're seeing landlords, we're seeing employers put more people in the same square footage. And certainly that changes the dynamic of the next construction cycle. But certainly I think fundamentals, we're seeing an improvement. And because there's low supply right now in the pipeline, I think that my expectation is that this will continue for the next 2 or 3 years, assuming that we continue to see the baseline economic growth that we're seeing today. I think, kind of switching gears and talking about capital, there's a lot of questions right now about, what's the right amount of capital in the system. Certainly you see influence from foreign buyers right now, and foreign buyers, purchased about $50 billion last year in commercial real estate, and that's a conservative number. It could be north of that easily. But that represents an all-time high, according to Real Capital Analytics, over the last 12 or 15 years. So certainly the implications of foreign money coming in is having an impact in the gateway cities, is having an impact in certain areas, and we're watching that because you're seeing some pretty robust growth in value of certain assets. But I think at the same point, it's an early indicator that we will continue to kind of see that money move into the U.S. And the reason I say that, if you're seeing cap rates of 3% on multifamily projects in the Northeast, and we're seeing them in the West Coast as well. And certainly, I think at some point, those folks get get some kind of price fatigue. And then you look at markets like Atlanta or St. Louis or Dallas, and you say, well, I can go buy the same asset for a 5.5 or a 6 cap, and so it looks attractive. And so I think that we'll begin to kind of, and we are seeing some of the early stages of that dynamic taking place. So talking about the banks are returning to lending, and so certainly that is making the availability of capital greater. So we've got foreign capital coming in, we've got the banks lending, CMBS is coming back and continuing to increase the breadth of the marketplace there, and certainly you have some of the lenders, other lenders, I guess for lack of better words, the life insurance companies and some of the hedge funds, and they certainly are making robust amounts of loans as well. So there is certainly a significant amount of capital right now in the marketplace. What does that mean? Cap rates, we've seen cap rates come down over the last 15 years. Certainly as the interest rate climate, begins to look like we're changing that and moving it upward. Certainly you wonder, what does that do for cap rates over time? But some of the information that we've pulled recently, it's my belief that the marketplace, has factored some of that in already. Reason being, so if we go back and look at 2007 and we look at the difference between the yield on the 10-year Treasury, which is essentially the risk-free rate, and cap rates were about 100 or 150 basis points above the 10-year Treasury yield. Today, that number ranges from 400 to 600 basis points and change. And so I think that if you were to begin to kind of see a movement upward, and we are seeing a little bit of movement upward in the last couple of months on the 10-year Treasury, I think it has negligible impact on cap rates in the short term.
Yeah, and let me ask you a little bit more about you mentioned foreign capital and those gateway markets where the cap rates are compressing. So for our friends in some of the secondary cities and tertiary markets around the country, they may start to see a little more benefit from that foreign capital there.
Absolutely. And I think that a lot of it's driven by where the buyer is coming from. For instance, you take Canada, which is historically in the top 3 purchasers of U.S. real estate, and they're very comfortable operating in the gateway cities, the secondary and the tertiary markets. I think they have a familiarity with how the U.S. market works. On the other hand, you look at money that's arguably kind of new to the system. For instance, you look at China right now, and they are very comfortable in operating in the gateway markets, and the assets there fit their purchasing and acquisition parameters. And so we're seeing a lot of money from China go into those markets. However, we're beginning to hear anecdotally that some of that money is moving out of those markets and into secondary and tertiary markets. So I think it's a good, good sign that the market is operating efficiently.
Yeah, and you mentioned cap rates being compressed and interest rates maybe ticking up, and what might happen with future cap rates. So, what would you tell a listener who's maybe buying an investment property and they're looking at their exit strategy 5 years from now? I don't know to see what that cap rate should be. I know when we were selling properties in 06 and 07, we kind of struggled with that. It was like, what do we tell? We know cap rates are going to be higher.
Right, and I left my crystal ball at home, and so I can't say, for instance, an exact number.
Yeah.
But I do think that if you take a kind of stress testing approach, a sensitivity analysis, and look at cap rates, and kind of say, okay, what does the scenario look like? Is it 50 basis points, 100 basis points, 150 basis points? I would really, it would be a stretch for me right now to see any scenario above that based on the marketplace and how they've widened out the premiums right now. I mean, back to what talking about the difference between the 10-year Treasury yield in 2007 and cap rates. I mean, arguably, things we probably were mispricing. The market was probably mispricing risk then, and so at its smallest place, it was 100 to 150 basis points. Today, it's 400 to 600 basis points. So I think that it'd be hard to kind of see a scenario where cap rates moved significantly in 5 years.
Yeah, that sounds good. And you also have the increase in fundamentals helping you anyway. Stay tuned. More on the Fed's view on commercial real estate. The Commercial Real Estate Show is brought to you in part by RealNex, providing a comprehensive suite of powerful commercial real estate tools at an incredibly low cost. Visit realnex.com. That's REALNEX. Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Thanks for being with us. We have Brian Bailey here from the Fed in Studio One in Atlanta. And Brian, we're talking about the impact of economic impact and real estate impact from foreign investors investing in the U.S. And some of that's been through the EB-5 program. Where are we in the EB-5 program, and how much of impact is that on foreign investment in CRE?
And a great question, and certainly some of that legislation is up in front of the legislative bodies this year, and so certainly, significant changes could have notable impacts to commercial real estate. If you look at the EB-5 program last year, 85% of the visas, and let me back up and just define the EB-5 program. So it's a basically a program where you can get an accelerated spot as far as getting a visa if you're willing to invest between $500,000 and $1 million in the U.S. That creates a certain number of jobs, and there are a number of other criteria that it has to meet. And there's a number of visas. There's a certain number of visas that the U.S. is allowed to grant every year. Last year, 85% of those visas went to someone from China, Chinese national, and so certainly we see significant influence in that money and its impact on commercial real estate in the gateway markets. And so certainly, if there was a notable change, it could have an impact on commercial real estate. And the same thing with the 1031 legislation right now.
Yeah. Well, gee, I might have to eat my grits with chopsticks then, That's going to happen. What about the 1031 exchange? It seems like the 1031 exchange process, the tax-deferred exchange, has been great for commercial real estate, economy, for jobs. There's some talk about, cutting that back. What kind of impact might something like that have?
Well, that market has been, in my view, that market has been red hot, and certainly any change could, pull that market back, and so certainly, something to watch. I don't have the exact information on what the implications would be, but if there were a pullback, certainly it would have ramifications for construction jobs and the availability of capital in some of that area. Yes.
Well, can you tell them from me when you talk to them that they need to leave it alone? We need it. You talk about how much business and money has moved. When a transaction happens, and the jobs and the construction jobs and the attorneys involved and all the vendors involved, it would be a significant impact on the economy, I think. And another question I think our audience has is Fannie and Freddie. What's happening there, and how much of an impact is that on CRE?
In my view right now is generally Fannie and Freddie are kind of in a holding pattern, waiting to kind of see, how the next election cycle plays out. But, their role in the marketplace, they certainly have a significant role in the marketplace. And so hopefully if there are changes that are coming, those changes are well thought out and well articulated to the marketplace, because Fannie and Freddie, I don't have the exact figures represent a significant piece of both the single-family financing market as well as the multifamily financing market, and so any change there has significant implications for construction jobs associated with both of those types of property, which are key drivers for gross domestic product.
Right, and then you're talking about residential development, the home market. I mean, that market has been doing well, hasn't it, in most parts of the U.S., and that's helping our economy and commercial real estate, right?
It's picking up. It's picking up. I think during 2011, we hit a bottom of about 430,000 starts, and I think that we've bounced upwards, and we're now between 600,000 and 700,000 starts a year. So certainly, we're picking back up, but compared to the 20-year average, which was over 1 million starts, we've got a long ways to go. And so certainly, like to see it, we're headed in the right direction, the trend's headed in the right direction, but we've got a ways to go to get back to kind of the 20-year average.
Right. And you talked about job growth earlier, and we're short on the break, but what do you foresee for job growth and its impact, say, on the office market?
And the Federal Reserve Bank of Atlanta and the Board of Governors in D.C. certainly issue projections as far as job growth is concerned. I think that I'm kind of in the same camp as a number of folks that believe that job growth kind of gets more robust later in the year. We've seen a little bit of doldrums and seasonality in the first part of the year, and there are questions about some of the seasonality implications on the numbers. But certainly, I think going into the latter part of the year, we're going to see some pickup in job growth. And anecdotally, I hear about job growth picking up. So certainly, we'll keep our fingers crossed.
Yeah, and that's good to hear, and we need it. It's certainly a boost to, especially the office market. Well, stay tuned. We'll have more on the Fed's view of commercial real estate. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. Xceligent, the resource professionals like CCIMs, CBRE, JLL, Colliers, and Bull Realty use for market intelligence. Commercial Search is the site to market and find available properties to buy, sell, or lease all over the country. Visit commercialsearch.com. Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Hey, we have some great shows coming up for you, so be sure to not miss a show of special interest to you. Sign up for a once-a-week email announcing the show topic at commercialrealestateshow.com. We have a great show for you today. It's the Fed's view on commercial real estate. We have Brian Bailey here with us from the Fed in Studio One. And Brian, there's always people who are concerned about the downturn and the headwinds and the problems and when they're coming and that sort of thing. What are some of the challenges for, I know you like to call them headwinds, right? Headwinds for CRE moving forward.
It all revolves around one word: uncertainty. And what's the uncertainty? Is it fundamental driven? Are we building too much? As in the case of people asking the question in apartments right now, is it regulatory uncertainty, which then that's going to put a burden on the banks and it's going to slow lending. So certainly people are concerned about uncertainty right now. I think a few topics that are being repeated in the conversations that I'm having with the community. One is foreign capital right now, and certainly there's some questions in the community about, is there too much of it? Certainly we continue to monitor that actively. Regulation is certainly another topic, and I think that we've come out of the downturn, and the legislation that came out of that accomplished exactly what it needed to do in shoring up the safety and soundness of the financial system. I mean, that's exactly now that conditions have changed. Certainly, there will be kind of a look back at some of that legislation to fine tune it, and certainly there's some uncertainty about what does that look like. I think third, which is kind of an interesting question is lending right now.
Mm-hmm.
Is the CMBS market? I mean, there's some talk right now that some of the underwriting standards are deteriorating, and again, it's the uncertainty. Yeah, right, absolutely, and we know that there's some overlap to the banking industry with that.
Yeah.
And so I think that there is some uncertainty, and the market, as we all know, does not react well to uncertainty.
Right.
And so I think that looking at that and trying to understand what does that look like and reduce the uncertainty is certainly something that we've heightened our surveillance of the marketplace to make sure that we're fully abreast of what's going on.
Yeah, and of course, one of the questions on everyone's mind is interest rate hikes, and when and how much, right?
I knew I couldn't get through a conversation without that topic coming up. I had my fingers crossed, but and it certainly is an interesting question, and certainly the uncertainty around that is causing the market to ask a lot of questions about what does that look like. Now, I'm not a member of the FOMC, the Federal Open Market Committee, and so really my views are based upon a lot of what I read in the press, and you can see a number of participants on the committee speaking in public about their thoughts. Certainly, I think a general characteristic of those conversations is the great news for the U.S. economy is we see employment continuing to grow, and so that's very good news. The decision is going to be well articulated. It's going to be data driven, and so I think that those are very good aspects for the marketplace to kind of factor into the decision. That I can't speak for certain, but it looks like a number of participants are kind of saying that the sweet spot may be later this year.
Mm-hmm. Yeah, and I've heard the same thing. Maybe in September, maybe we go up quarter of a point or something. But one of the things I think in commercial real estate, we're really tuned in to interest rates. But one thing we've got to keep in mind, right, is that an increase in interest rates means the economy's doing better too. The companies are doing better. They're going to expand. We're going to need more commercial real estate, right?
You bet. And that's certainly we're seeing the pickup in office using employment. We're seeing pickup in construction jobs, and so certainly I think that and the gross the GDP numbers weren't great this morning that were released, but I think we all kind of figured that the first quarter numbers would be kind of tough with all the seasonality and weather issues. So I think that if we continue to look toward the end of the year, that the expectations of increasing and accelerating growth will occur, and I think that we'll continue to have these conversations toward the end of the year.
And as far as that, the impact of interest rates on cap rates, I guess you said earlier that you think maybe commercial real estate practitioners have kind of taken that in consideration, and then maybe also the increase in just fundamentals, right? That if the economy's doing better, we're probably going to have some more rent increases, hopefully, and occupancy improvements.
Right, and I think a lot of the driver right now for cap rates, certainly you have the 10-year Treasury and the implications for interest rates, but also really it's part of the supply and demand equation as far as you have a vast wave of capital continuing to look for and have a big appetite for purchasing commercial real estate. And so you have this kind of maybe upward influence if interest rates do move upward at some point later this year. I do think the market has factored that in to cap rates, but at the same point you have a significant amount of capital that is looking to be deployed in a safe environment, and one of those safe environments is U.S. commercial real estate. And so I think that you see that implication as kind of a downward push on cap rates over the short term.
Yeah, and commercial real estate is a hard asset. It's never going to go down to nothing, right? That's for sure. Well, stay tuned. We'll have more of the Fed's view on commercial real estate. This is the Commercial Real Estate Show. I'm Michael Bull. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Advisors, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive and powerful suite of commercial real estate tools at an incredibly low price. Visit realnex.com. That's REALNEX. Xceligent, the resource professionals use for commercial real estate information. Visit xceligent.com. That's XCELIGENT. Commercial Search, the source to market and source available properties for sale or lease. Visit commercialsearch.com. For more information on these great companies or for additional videos, podcasts, or articles, visit creshow.com. Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Thanks for being with us. Our show today, the Fed's View on Commercial Real Estate. We have Brian Bailey from the Fed with us here in Studio One in Atlanta. And Brian, I think one of the sectors that maybe has been the last to improve, and some people are a little bit concerned about is retail. You know, with online sales continuing to increase. Some people are seeing retail centers, especially out suburban, ex-suburban ones, maybe still sitting empty, but some are doing extremely well, right? What do you guys think about retail real estate, and what do the banks think?
I think that retail real estate probably is the most susceptible right now to the changing consumer preferences. For instance, traditional bricks and mortar retailing sales are growing at 2 to 4%. But the e-commerce retailers, their sales are growing 12 to 14% a year. So certainly it's not a very big piece of the market. I would say it's probably 6 to 8% of the overall kind of retail market. But at the same point, it's growing, significantly right now. And I think that does have, real ramifications for retail real estate. And we see it, in some of the retailers that have gone bankrupt, or they're trying to change their strategy. And I think a lot of that is driven by, how close to a commodity it is. For instance, you've seen the retailers of books have significant tough time, significant challenges, as well as retailers within the electronics realm. And so I think that commodity-based retailers are having a struggle. Again, retail is a very broad topic, and just deep discounters I think have done pretty well through the downturn and coming out of the downturn. And I think retailers in the luxury realm have done very well. There's some pockets locationally that have done well, but certainly we see a fair amount of retail that's struggling right now. And I think that it is a question in my mind. What does that look like? And the e-commerce growth is certainly having an impact. You look at all the news around drones right now. I mean, 2 months ago, I believe Amazon got a conditional permit to try to fly drones outside, outdoors. You probably saw the publicity stunt with Domino's Pizza, where they were delivering pizzas by helicopters in the United Kingdom. We've had some enterprising individuals here, where I think we had an outfit in Wisconsin, delivering beer to the ice fishermen. And obviously they didn't have an FAA permit, so I think they had some challenges there. But we see some of the cusp, I think, of innovation in that arena, and how does that have implications for retail? Also, you look at Uber. I mean, Uber is now piloting a home delivery type service in the Northeast for groceries. And there's talk about some other things. So I think consumer spending can change fairly easily. I mean, you can make the decision, I'm going to drive to the store today, or I'm going to purchase it online, and if you do next day delivery, you'll have it tomorrow, or something very quickly. And so I think that the consumer is changing their dynamics of how they purchase space. On the other hand, from a supply standpoint, the U.S. has arguably the highest per capita square footage number of any nation across the any nation across the world. We are double what Canada has. I think the U.S. has about 25 square feet per person. And Canada, it's like 12.
Yeah.
And then you go to Western Europe, and it's 5 feet per person.
Yeah. Well, retail certainly has some opportunities out there, too. It's kind of a risk-reward thing. Well, Brian, thanks for joining us today. We appreciate it.
Thank you, Michael. Glad to be here.
Be sure and join us next week. We have Reese on Real Estate with Ryan Severino. It will be a great show. Until next week, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Advisors, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive and powerful suite of commercial real estate tools at an incredibly low price. Visit realnex.com. That's REALNEX. Xceligent, the resource professionals use for commercial real estate information. Visit xceligent.com. That's XCELIGENT. Commercial Search, the source to market and source available properties for sale or lease. Visit commercialsearch.com. For more information on these great companies or for additional videos, podcasts, or articles, visit CREshow.com.